In the U.S. mortgage market, trouble rarely arrives as a headline first. It arrives as a missed payment that someone swears is just this month, a late fee that wasn't in the budget, and a quiet fear that the next bill will tip the whole household over, and then suddenly the data catches up. According to ICE Mortgage Technology's November 2025 first look, the national delinquency rate jumped to 3.85%, with past due mortgages rising by 275,000 to roughly 2.3 million, the highest level in more than 4 years. HousingWire reports IC's view that much of the spike was driven by calendar effects, but the same report highlights a detail that should make every consumer and operator pay attention. 609,000 borrowers who were current in October became newly delinquent in November, the largest single-month inflow since May 2020. Now widen the lens. MBA's National Delinquency Survey shows 2025 was NT, a straight line. It was a pressured pattern. 4.04% in Q1, 3.93% in Q2, 3.99% in Q3, with the stress increasingly concentrated in FHA performance as affordability tightened. So the question is urgent. Is November a harmless calendar blip or the moment the post-pandemic mortgage normal finally starts to crack? In the U.S. mortgage market, the warning lights rarely flash all at once. They flicker: one missed payment, one late fee, one household deciding whether groceries come before escrow. Then a single month arrives that forces everyone to look up from the day-to-day and admit the stress is spreading. That's what November 2025 did. According to ICE Mortgage Technology's first look report, the national delinquency rate jumped to 3.85%, with past due mortgages rising by about 275,000 to roughly 2.3 million, the highest level in more than 4 years. And according to HousingWire's coverage of the same ICE data, 609,000 borrowers who were current in October became newly delinquent in November, the largest one-month inflow since May 2020. ICE notes calendar effects likely amplified the spike. November ended on a Sunday, pushing some payments past month-end, but that does not make this story safe. Because when you step back and look at January through November 2025, you see a year defined by pressure, not relief. Stubborn affordability, higher insurance and tax burdens, and a growing divide between borrowers with cushion and borrowers living on the edge. MBA's National Delinquency Survey shows delinquencies running near the 4% level through 2025, with performance stress increasingly concentrated in government-backed borrowers, especially FA, and the New York Fed's household debt and credit reporting underscores that while some credit categories are driving more delinquency transitions, mortgage trends have been mixed, meaning the national averages can hide localized pain until it breaks into the open. In this video, we're going to trace what's really happening in US mortgages from January to November 2025, what's seasonal, what's structural, and where the next cracks are most likely to spread. If you want more documentary-style breakdowns like this, hit like, subscribe, and tell me what city and country you're rewatching from, because your support is what makes these deep dives possible. For transparency, every data source cited in this video is listed in the description. From January through November 2025, the U.S. mortgage market told a story that looks calm at the surface and tense underneath, because averages can stay normal, right up until the moment a large group of borrowers runs out of slack. The year began with delinquency levels that still looked like a post-pandemic normalization rather than a crisis. But the direction of travel mattered. The system was quietly shifting stress toward the most affordability-sensitive borrowers, especially those in government-backed loans. The Mortgage Bankers Association's National Delinquency Survey showed the overall delinquency rate at 4.04% in Q1 2025. A reminder that the easy money period didn't end without bruises. In isolation, 4% does not sound dramatic, but in real life, it's families making choices. It's first-time buyers who stretched to purchase during the highest price, highest cost environment in a generation, and now they're discovering that the mortgage payment is only the start. Taxes adjust. Insurance renews higher. Grocery bills don't reverse the way CPI charts do. And when cash buffers thin out, delinquency becomes a lagging indicator of stress that's already been present for months. By Q2, MBA showed a slight improvement, 3.93%, but the word improvement can be misleading, because the system was not healing evenly. A market can post a modest quarter-to-quarter decline while still building risk in specific pockets. Borrowers with smaller down payments, thinner credit margins, or households hit hardest by rising non-mortgage costs. That's where the human picture matters. A borrower does not go delinquent because they forgot the date. They go delinquent because one category of life expense, care, medical bills, insurance, car repairs suddenly becomes the bill that crowds out everything else. Then in Q3, delinquency rose again to 3.99%, with reporting emphasizing that FHA performance was the driver. This is the pattern operators need to internalize. Not a broad-based mortgage collapse, but a concentrated affordability squeeze that targets the very cohort the housing market depends on for future demand: younger moderate-income buyers who used FHA to get through the door. Industry commentary around the Q3 survey noted that FHA serious delinquency 90-plus days past due was up materially from a year earlier, And once serious delinquency starts climbing in that segment, it matters to everyone. To lenders because it changes loss expectations. To servicers because it increases workload and operational risk. To agents because it can create distressed listings later. And to consumers because it's often the first place where tighter credit standards are born. That same concentration shows up in broader credit data. The New York Fed's quarterly report on household debt and credit described overall delinquency rates as elevated with mixed transitions into early delinquency, and it specifically noted that mortgage delinquency transitions had been comparatively stable to slightly improving in some periods. Even while other consumer credit strains intensified, that is not comforting. It is a warning about sequencing. Historically, when consumer stress builds, it often hits credit cards and student loans first, then works its way toward housing when savings and refinancing options are exhausted. Reuters reporting on the New York Fed SQ 22025. Debt data highlighted that student loan delinquencies jumped sharply after repayment pressures returned. While mortgages remained comparatively strong over Elliott FHA, delinquencies rose the most within housing. Translation: the system is dividing into two realities at once. Borrowers with equity and stable incomes who can manage the payment stack, and borrowers who bought into the market at the edge of affordability and have less room for error. Summer provided a temporary sense of relief in the monthly data. National Mortgage News reported that the national delinquency rate was 3.27% in July 2025, down from the prior month, consistent with typical seasonal improvement. ICE also noted in its August 2025 first look that the delinquency rate rose to 3.43% and that the market was returning to year-over-year increases after temporary reprieves earlier in the summer, an early sign that the floor under delinquencies was drifting upward. This is how shifts happen in real estate credit, not a straight line, but a staircase. Down a little, up a little, until you look back and realize the whole staircase moved higher. That brings us to November, the month that forced the market to stare at the trend. ICE's November 2025 first look reported the national delinquency rate jumped to 3.85%, with past due mortgages rising by 275,000 to about 2.3 million, and an inflow of 609,000 newly delinquent borrowers, the largest single-month inflow since May 2020. ICE emphasized that calendar and seasonal effects likely amplified the spike, with month-end timing pushing some payments past the reporting cutoff. But even if you discount the calendar distortion, the inflow number should not be dismissed as noise, because calendar effects create stress. They reveal how many borrowers are close enough to the edge that a timing shift can tip them into delinquency status. The 2025 message, from January through November, is therefore not 2008 all over again. It's more dangerous in a different way. It asks a targeted squeeze on the marginal homeowner, the first-time buyer, the FHA borrower, exactly the segment that powers market turnover and future demand. And once that segment starts slipping, the market's next phase tends to arrive quietly: tighter underwriting, fewer approvals at the margins, and a slow change in who gets to buy the next house. If the first chapter of 2025 was about stress concentrating in the most affordability-sensitive borrowers, the second chapter is about what that stress does when it meets the machinery of mortgage finance. Servicers, credit standards, foreclosure pipelines, and the psychology of, can I still move? Because in a housing market, delinquency is never just a household statistic, it's a transmission channel. Start with the monthly rhythm that set up November's shock. ICE's August 2025 first look showed the national delinquency rate rising to 3.43%, and emphasized that the market was returning to year-over-year increases after brief summer reprieves, with foreclosure activity slowly trending higher. September looked steadier on paper. Reported the delinquency rate fell to 3.42%, with improvement across early and late-stage buckets. Even that press release flagged a critical warning. FA foreclosures emerging, a phrase that matters because FHA is where affordability stress tends to break through first. October then brought another improvement. ICE reported delinquencies falling to 3.34%, and the market could have mistaken that for a clean trend. But November snapped the illusion. ICE reported the delinquency rate jumped to 3.85%. Past due loans rose by 275,000 to about 2.3 million, and 609,000 borrowers rolled from current to delinquent, the largest one-month inflow since May 2020. Even as ICE stressed that seasonal and calendar timing amplified the spike. Here's what professionals should hear in those monthly moves. This is a system where a large number of borrowers are close enough to the edge that timing can push them over. Calendar effects don't create distress. They expose how thin the margin has become, and the margin has become thin for reasons that are not primarily about mortgage rates for existing homeowners. Most borrowers are locked into low rates from prior years, which is why this cycle does not look like 2008. The pressure is coming from the payment stack around the mortgage, taxes, insurance, and other debts that compete with the mortgage every month. That helps explain why the deterioration keeps showing up in FHA performance. MBA's National Delinquency Survey showed the overall delinquency rate near 4% through 2025 and highlighted that the Q3 increase was driven largely by When FHA starts to wobble, the foreclosure pipeline is where the market watches next, not because the nation is about to flood with distressed supply, but because foreclosure starts are a leading indicator of how servicers and lenders are interpreting borrower weakness. Investopedia summarized the dynamic, sharply reporting that although FHA loans are a minority of active mortgages, they represented nearly half of foreclosure starts in Q3 2025, and cited analysis showing materially higher delinquency among FHA borrowers than the broader mortgage population. This is the point where operators must get serious. A rise in government-backed loan distress can tighten credit at the margin, even if conventional credit stays stable, because risk appetite changes fastest where losses appear first. Now zoom out to the consumer reality behind that pipeline. When a first-time buyer becomes 30 days late, it often isn't because the mortgage rate reset, it's because everything else didn't. Student loan obligations returned, car insurance and homeowners insurance rose, property taxes adjusted, wages didn't keep pace for everyone. That is why the New York Fed's household debt and credit reporting has been watched so closely. The Fed's data have shown that delinquency transitions can rise in certain consumer credit categories, even while mortgage performance remains comparatively resilient overall, creating a sequencing risk where household stress builds outside housing until it spills into housing. In prior cycles, that spillover is exactly how localized strain becomes broad caution. Lenders tighten, buyers qualify for less, and transaction volume suffers even if nominal home prices don't instantly collapse. This is where 2025 starts to rhyme comfortably with past episodes, even if the causes differ. In 2006 and 2007, the US didn't feel like a crash everywhere at once. It felt like rising cancellations, rising incentives, and pockets of delinquency that many dismissed as contained. In 2020, the shock was immediate, but policy created a bridge so delinquency spikes were managed through forbearance and loss mitigation tools rather than mass foreclosure. November 2025 at the significance is that it reminds the market what happens when a large cohort is operating with little slack. The system can move suddenly, and the data can appear to jump even when the underlying stress has been accumulating quietly. There is also an opportunity embedded in this moment, and it matters for both consumers and operators. The opportunity is early intervention because early-stage delinquency is where outcomes are still malleable. If you're a homeowner, the difference between one missed payment and a cascade is often speed. Contacting the servicer early, understanding repayment options, and addressing insurance and escrow shocks before they become unmanageable. If you're a lender or servicer, the opportunity is operational discipline, identifying stress early, deploying loss mitigation efficiently, and avoiding the reputational and portfolio damage that comes from letting borrowers drift into serious delinquency without a plan. But the threat remains. If FHA distress continues to be the canary, credit availability for the next cohort of buyers can tighten right when the market needs fresh demand. That's how a delinquency story becomes a housing market story, not necessarily through a wave of foreclosures, but through a slow constriction of who can qualify, who can close, and who can keep a mortgage stable when the rest of life gets more expensive. From January through November 2025, the US mortgage market didn't scream. It whispered until November forced the whisper into the open. According to ICE Mortgage Technology's November 1st look, the national delinquency rate jumped to 3.85%. Past due mortgages rose by roughly 275,000 to about 2.3 million, and 609,000 borrowers who were current in October became newly delinquent in November. And inflow, ICE described as the largest since May 2020, even while noting calendar effects likely amplified the spike. The lesson is that timing doesn't create distress. It exposes how many households are close enough to the edge that a small disruption, month-end timing, an escrow adjustment, a medical bill pushes them into delinquency status. And the broader 2025 pattern suggests the stress is not evenly distributed. MBA's delinquency surveys showed overall mortgage delinquency hovering near 4% across 2025 quarters, with the pressure increasingly concentrated in FHA performance. That matters because FHA is where the market's marginal buyer lives, and the marginal buyer is what drives transaction velocity in the housing economy. So what should you do with this right now? If you're a homeowner, treat delinquency risk like a solvable operational problem, not a moral failure. The moment you see the budget tightening, take action early. Audit, escrow, shop insurance, request hardship options if needed, and contact the servicer before the loan rolls past 30 days. In most cases, the difference between a short disruption and a long financial scar is speed. If you're an agent, lender, builder, or investor, the lesson is to stop modeling the mortgage payment as the whole affordability story. Model the payment stack: taxes, insurance, HOA dues, and consumer debt stress. Track the segments where early-stage delinquencies are concentrated, because that's where underwriting tightens first, and prepare for the second-order effects. Fewer approvals at the margin, more deal fallout tied to payment shocks, and localized pockets of distress that can create both risk and opportunity, depending on how quickly you recognize them. Most importantly, do not misread this as 2008. It is not the same structure, but it can still produce real damage in the places that matter most. first-time buyers, FHA borrowers, and households with thin buffers. The market doesn't need a wave of foreclosures to slow down. It only needs the marginal buyer to lose access and the marginal homeowner to lose slack. So here's the question for you to answer in the comments. Was November 2025 a harmless calendar distortion or the first visible crack in a year-long affordability squeeze that will reshape mortgage access in 2026? If this analysis helped, hit like, subscribe, and tell me what city and country you're rewatching from, because your support keeps these data-driven deep dives coming. And for transparency, every data source cited in this video is listed in the description.